Welcome to the Deep Dive. We're the analysis hub where we dig through, well, mountains of complex source material to pull out the insights you actually need. Today, we are really opening the books on one of those quiet giants in global business, Cencora Inc. That's ticker COR. Now, Cencora, it's more than just a huge company. It's like the physical plumbing that holds up the entire modern healthcare system. They're that critical middleman, the indispensable central nervous system, making sure medicines get where they need to go, from simple generics all the way to those super complex temperature sensitive biologics manufactured shelf to the patient. And the scale we're talking about here is just staggering. Fiscal year 24 revenue, $294 billion. It's up a solid 12.1% year over year.
Yeah, that kind of volume, it's almost hard to wrap your head around. But here's the paradox, right? The thing we really need to unpack for you today is this core strategic tension defining where Cencora goes next. They've got this incredible growth on the top line. I mean, faster than a lot of their peers, actually.
Yeah.
But, and this is the big but, that growth is putting serious pressure on their profit margins, which were already, historically, razor thin. If you zoom right in on the numbers, you see this giant, nearly $300 billion company running on an adjusted operating margin of just 1.22%.
1.22%. I mean, that's practically a rounding error on a spreadsheet that big. So it means Cencora is basically navigating this strategic crossroads. Their main engine, it's humming along, throwing off massive amounts of cash, but the actual profit percentage is structurally getting smaller. So our mission here in this deep dive is to trace Cencora's very deliberate, very critical response to this. They're using that core cash flow, that huge, predictable river of money to, well, aggressively buy up businesses, businesses with higher margins, service-focused businesses, trying to offset that erosion in the core.
It's absolutely a high-stakes race.
Yeah.
They're effectively trying to, re-engineer their income statement on the fly while still managing this absolutely gargantuan scale of operations.
Yeah.
In our analysis today, it's grounded in detailed investment reports, company filings.
Yeah.
We're going to show you exactly why they have to make this shift now, what that core business is really built on, and importantly, where the biggest risks are lurking.
Okay, let's start there. Let's unpack that structural foundation.
Right, so if you really want to get Cencora, you absolutely have to understand the world it lives in.
Yeah.
The U.S. pharmaceutical distribution scene, it's a classic oligopoly, really durable. It's dominated by what everyone calls the big three: Cencora, naturally, McKesson, and Cardinal Health. Between those three, they control well over 90% of the entire U.S. wholesale market. That concentration, that's the source of their stability. It's their defensive economic moat.
Okay, but here's the question, right? For anyone listening closely, why hasn't this market been blown up? We see disruption everywhere else. How come some, tech giant like Amazon or maybe a huge retailer hasn't just jumped in and started undercutting them? What are those key barriers keeping this setup so stable?
That's the multi-billion-dollar question, isn't it? And the moat, well, it's deep. And it's got multiple layers. First off, it's just sheer scale and the capital intensity. You can't just, rent a couple of warehouses and call yourself a distributor. You need hundreds of these massive, technologically advanced distribution centers spread out geographically, running 247. And increasingly, with the shift towards biologics.
Right, those complex drugs.
Exactly. Vaccines, gene therapies, cancer drugs, they demand specialized infrastructure. We're talking validated cold chain, even ultra cold chain facilities, some needing minus 80 degrees Celsius. That's a colossal sunk cost, billions of dollars. It basically acts as a gatekeeper right off the bat.
So it's not just big warehouses, it's highly specialized technical infrastructure, locks out the smaller guys, even medium-sized players.
Precisely. And that connects directly to the second barrier, which people often overlook: intense regulatory complexity. They have to navigate these really strict federal rules. The big one is the U.S. Drug Supply Chain Security Act, the DSCSA.
DSCSA, we hear that acronym tossed around, but break it down. Why is that part of the moat?
Well, the DSCSA, it demands full, interoperable, unit-level track and trace, thick level 4 data. Every single bottle, every vial has to be tracked electronically, from the moment it leaves the manufacturer, all the way through the network, right into the pharmacy or hospital. For a company like Cencora, that means integrating really complex real-time tech across a network, handling, well, hundreds of billions in product value every year. It's a huge ongoing tech investment.
Okay.
Now, imagine you're a potential competitor. Building that system, validating it, getting it certified. It's not just incredibly expensive, it's super risky. Fail a regulatory audit, and you're basically out of business before you start. Cencora, just by existing and operating, offers, like compliance as a service, that deep regulatory know-how. It just reinforces their position.
That's fascinating. So the regulation, which is there for safety, kind of unintentionally locks in the big players by making the entry cost astronomical.
Absolutely. It solidifies the oligopoly. And then the third layer, it's almost mundane but crucial economies of scale. Because the big three buy in such massive volumes, negotiating for pretty much the entire U.S. healthcare system. They get the best terms, favorable payment terms, pricing from manufacturers. That efficiency is really the only way they can survive on those incredibly thin margins we talked about.
Yeah.
Hashtag A, the oligopoly and the economic moat.
Yeah, let's tackle those thin margins directly, because this is where the financial mechanics get really interesting. How does a company pulling in just 1.22% operating margin generate these, frankly, incredible returns? A 5-year average return on invested capital, ROIC, of 57.3%, and a trailing 12-month return on equity, ROE, of 167%. I mean, those numbers look like they belong to a software company, not a logistics firm.
Oh, right. That's the secret financial sauce of this oligopoly. Analysts often call it the float. And it comes purely from operational excellence and, critically, working capital management.
Yeah.
These companies basically operate on a model of negative working capital.
Okay, walk us through that. Negative working capital. How does the float actually work?
Okay, think about the cash flow cycle. Cencora buys drugs from, say, Pfizer or Merck. But because of their immense buying power, they negotiate long payment terms. Maybe 60 days, 90 days, sometimes even longer before they have to pay the manufacturer.
Right.
Then they immediately turn around, ship those drugs to hospitals, pharmacies, who typically pay Cencora much faster, often within 30 days, sometimes less.
Ah, okay, so Cencora gets the cash in from the customer before they have to pay the cash out to the supplier.
Exactly. And they hold the inventory for a remarkably short time. Their inventory turnover is incredibly rapid. So that gap, getting paid quickly, paying slowly, creates this huge continuous pool of cash. It's essentially an interest-free loan from their suppliers that Cencora uses to run its business. The business is, in effect, self-financing. Because their actual invested capital base is technically negative, or at least very, very small compared to that enormous revenue, even that tiny 1.22% margin generates these eye-popping returns on the capital they do have deployed. Profitability isn't about high markups. It's about the sheer speed and efficiency of cash flow.
That completely reframes how you think about the business. They're like the utility company for the drug supply chain, sure, but they're also these incredibly sophisticated financial operators leveraging their indispensable position.
That's absolutely the key takeaway. Their revenue stream is non-discretionary. Hospitals need those daily or near-daily deliveries. That makes their cash flow super recurring, super predictable. And that predictability, that's what lets them walk that tightrope of low margins and high volume, hashtag BB, a tale of two segments.
Okay, now that we get the financial engine, let's look at where all that volume comes from. Because Cencora is really built on two distinct segments. The main force, the cash flow engine we were just talking about, that's the U.S. Healthcare Solutions segment. The domestic powerhouse. Fiscal 24. This segment alone pulled in a stunning $265.3 billion in revenue, which translated to about $2.935 billion in adjusted operating income.
And that segment, it touches every part of the U.S. healthcare system. Hospitals, big health systems, yeah, but also independent pharmacies, the huge chains like Walgreens and CVS, mail-order operations, clinics, doctors' offices. They're pushing out everything. Branded drugs, generic, specialty meds, over-the-counter stuff, basically to every single point where a patient gets care in the U.S. The U.S. segment isn't just most of the business. It drives almost all the profit and, crucially, that cash flow.
Right. And then sort of complementing that, you have the International Healthcare Solutions segment. It's smaller, yes, but it serves a couple of key strategic roles, geographic diversification and specialty expertise.
Yeah, the international piece brought in $28.6 billion in revenue in FY24, which generated about $713 million in adjusted operating income. The diversification. That mostly comes from Alliance Healthcare over in Europe. It's a major distributor in several key European countries, but arguably the more strategically interesting piece within international is World Courier.
World Courier, right? That's their global specialty logistics arm. Why is that particularly important?
Because it handles the really tricky stuff. High-touch, high-complexity logistics. moving critical, super valuable, often ultra-temperature sensitive things like clinical trial materials or commercial biologic drugs across international borders. Now, this segment should capture slightly better margins because of that complexity. But it also exposes Cencora to things like foreign currency swings and, well, a whole patchwork of different regulatory systems, unlike the more unified U.S. market.
And as we're definitely going to get into, that international segment, especially when it comes to M&A they've done there, has shown just how risky it can be to step outside that core distribution expertise. So, important to remember, the cash engine is domestic U.S. distribution. The growth and diversification efforts are more global, more service-oriented.
Okay, so this really brings us right to the heart of the strategic challenge, that central tension. Sencora's growing like gangbusters, incredibly fast top-line growth. But structurally, the percentage of profit they make is shrinking. Let's look at what's driving that huge growth first.
Well, the big picture tailwinds are pretty clear, right? Aging populations globally mean more people using more medicines, just rising pharmaceutical use across the board. But the real story, the trend that's defined the last decade or so, it's the explosion in specialty drugs.
Specialty pharma. That's the absolute game changer. We're talking high-cost, complex, biologic therapies. Things for cancer, rare genetic diseases, HIV, autoimmune conditions. They often need special handling, maybe infusion, close patient monitoring, and critically for Cencora, strict temperature control during shipping and storage.
And the numbers showing how much they dominate the market now are just, well, they're stunning. Specialty drugs make up 54% of total spending on pharmaceuticals in the U.S.
Yeah, let that sink in. Over half the money spent on drugs is concentrated in this tiny slice of the actual prescription volume. Only about 2% of prescriptions are for specialty meds. So this is the primary engine driving market growth for Cencora. And like we talked about earlier with the moat, the complexity here needing that cold chain, the special handling it, actually strengthens Cencora's competitive position. Smaller players just can't afford to build out that capability. So it's kind of a double win for them. Huge growth and stronger defenses.
Okay, but here comes the contradiction we flagged earlier. This rapid growth leads straight into the main source of margin pressure. It's this extraordinary recent surge in demand for a different class of drugs, the GLP-1 agonists, the ones for diabetes and increasingly the ones making headlines for weight loss.
Exactly. The source materials are clear. Cencora themselves called out these super high-demand GLP-1 drugs as a key factor boosting their top-line revenue. I mean, these things are flying off the shelves volume-wise. But here's the rub, the structural drag. Cencora management explicitly stated that these high-volume products carry lower profit margins than the average across their broader portfolio.
Okay, let's try an analogy and make this really concrete for everyone listening. Imagine Cencora is like a massive high-speed freight train. They keep adding more and more freight cars. That's the growing revenue volume, especially because of the specialty drug boom. But these newest cars they're adding, the GLP-1 cars, the stuff inside them is just structurally less valuable, less profitable per unit than the average cargo they were already carrying.
That's a perfect analogy. They're running the train faster, hauling more total weight, hitting record distances covered. That's the revenue. But the mix of goods inside the train is actively pulling down their overall profit percentage per mile. They're moving faster, but their overall, let's say, cargo value density is declining.
And we know this isn't just theory, right? We can actually see this drag in the numbers. This specific shift in product mix, heavily influenced by GLP-1s, caused their adjusted gross margin to drop by 24 basis points in Q4 of fiscal 24. And critically, the adjusted operating margin shrank by 8 basis points. That is a measurable, significant erosion, and it's tied directly to the composition of their own success.
Exactly right. And that shift means management can't just tweak things anymore. They can't just, manage inventory a tiny bit better or run the warehouses slightly more efficiently. They've kind of run out of room for purely operational fixes to solve this. The sheer scale of this high-volume, low-margin growth presents a secular challenge. They fundamentally have to change the type of revenue they're bringing in. They need to find revenue streams that maybe have, say, 10% or 15% operating margins to help balance out the 1% drag from the core business.
So what's the takeaway for Cencora's strategy then? It really means they can't just keep being the highly efficient, high-volume middleman. That model is facing diminishing returns, percentage-wise. The only real defense against this kind of secular margin erosion is, well, a calculated offense, a strategic pivot. They basically have to re-engineer their income statement from the inside out. And doing that takes fuel, lots of predictable fuel.
And that fuel, that's their cash flow machine. We keep coming back to it. Despite those razor-thin operating margins, the sheer scale of Cencora means it generates enormous and remarkably predictable free cash flow, or FCF. They generate $3.1 billion in adjusted FCF in fiscal 2024. And they've guided for another, very strong $2.0 billion to $3.0 billion for fiscal 25.
That cash is the strategic weapon, really. It gives them the breathing room, the flexibility to invest heavily in this transformation while keeping the core business stable.
Right. And their capital allocation philosophy, it seems built on discipline. They use this cash first to fund that migration into higher margin businesses. But critically, they also maintain a really strong commitment to returning capital to shareholders. You can see their confidence in that core cash flow just by looking at their dividend history. 20 straight years of dividend increases, including an 8% hike announced just last November.
20 years of raising the dividend. That really signals that management believes the core business, even with margin headwinds, is solid enough, predictable enough to fund this big strategic shift.
It certainly suggests that. They're not stretching either. They keep a very conservative adjusted earnings payout ratio, only around 22.7%. That leaves plenty of cash left over for reinvestment in these acquisitions. They also actively buy back shares, returned about $1.9 billion to shareholders in FY24 through dividends and buybacks combined. So this financial strength, this flexibility, it's the absolute prerequisite for the strategic M&A we need to talk about now.
Okay, so the strategy is pretty clear. Find and acquire businesses that offer higher margins, that are service-oriented, but also have some kind of synergy, some connection to their existing pharmaceutical expertise. And the prime example, the cornerstone of this move, seems to be their acquisition of Retina Consultants of America, RCA.
Yeah, the RCA deal is significant. It closed officially on January 2nd, 2025. And it's a major, very deliberate signal about where Cencora wants its future income to come from. RCA is a leading MSO, a management services organization. Now, for listeners who aren't familiar, MSOs don't actually employ the doctors or practice medicine themselves. What they do is provide all the essential non-clinical support, administrative stuff, billing, HR, IT, sometimes even clinical support staff, to physician practices. It lets the doctors focus just on treating patients.
And it seems like a fantastic fit, doesn't it? Because it plugs Cencora deeper into the specialty physician practice world, which is already a key customer segment for their distribution business. And specifically in retina care, well, that's a field that uses a lot of very complex, very expensive specialty drugs Cencora is likely already distributing. So now they're layering this high-margin service revenue right on top of that existing relationship.
Exactly. It's synergistic. And the financial expectations management has set are really quite high, which kind of reflects the urgency of this margin migration strategy. They've stated that RCA is expected to add about $0.35 to adjusted earnings per share in its first full year. And that's net of the financing costs for the deal. That $0.35 per share coming from high-margin services. Remember, not 1.22% distribution margins. That is the direct financial counterweight Cencora is trying to build against that GLP-1 margin drag. Hashtag the M&A execution risk and the warning sign.
Okay, adding $0.35 to EPS from a service acquisition, that sounds great on paper, but we absolutely have to inject a dose of reality here. This strategic pivot, this M&A-led transformation, it's definitely not risk-free. If RCA represents the hopeful future, then the recent, rather large goodwill impairment charge they took on the Pharmalex business, well, that's the clear, quantifiable warning sign that M&A is hard, really hard.
It really is. It's the practical and frankly expensive demonstration of execution risk. Maybe we should quickly define what a goodwill impairment is for listeners. When Cencora bought Pharmalex back in 2023, like any acquisition, they paid more than the book value of Pharmalex's physical assets and liabilities. That extra amount they paid, that's recorded on the balance sheet as goodwill. And it basically represents the value Cencora assigned to the expected future earnings and synergies they hope to get from Pharmalex.
Okay, so when they take an impairment charge against that goodwill later on, what's that telling us?
It's basically Cencora admitting, officially on their books, oops, our initial assumptions were too optimistic. It signals that those expected future earnings from Pharmalex are not going to materialize at the level they originally projected when they bought it. They effectively overpaid based on flawed forecasts. And the reason they gave for the Pharmalex write-down, they said the business's growth just wasn't meeting those original expectations, citing broader demand challenges in its specific market niche.
Which immediately flags the core challenge of this whole repositioning strategy, right? Cencora's DNA, their core competency, is logistics and distribution. Operational excellence defined by efficiency, speed, accuracy at massive scale. but providing specialized high-margin services. That requires a totally different operational playbook, different skills, maybe a different culture. And that integration risk, that execution risk, is now staring them in the face, quantified in a painful write-down.
That's the absolute critical distinction.
Yeah.
It makes the successful integration of RCA, getting that $1.35 accretion, even more crucial. It's now the key test for the relatively new CEO, Robert Mark, who got promoted from within late last year in Q4 FY24. The market, and certainly investors, are watching very closely. They're betting heavily that March and his team learned some hard lessons from PharmaLex and can execute flawlessly on integrating RCA. If they stumble with RCA too, well, that premium valuation we'll discuss starts to look very shaky very quickly. Hashtag V, financial context and pure benchmarking.
So to really grasp the difficulty of this balancing act Cencora is attempting, we should probably zoom back out for a second and just appreciate the incredible financial efficiency that comes with their sheer scale, especially in that dominant U.S. segment.
Yeah, it's worth just quickly reiterating those numbers. The U.S. segment grew from around $216 billion in fiscal 22 up to over $265 billion in fiscal 24. It confirms, that this is the absolute engine driving growth for both revenue and income for the whole company.
Yeah.
And that massive scale, combined with that negative working capital model we discussed, that's what spits out those phenomenal capital return metrics we mentioned earlier.
Right, that 5-year average ROIC of 57%, the TTM ROE over 160%. Even with those paper-thin operating margins, those kinds of ratios are just textbook signs of a powerful oligopoly. A business so entrenched, so incredibly efficient at using its relatively small equity base that the returns almost seem unreal. The key really is turning over inventory and cash at lightning speed.
Precisely. They're effectively using their suppliers' cash to fund their operations due to that payment cycle float. And that hyper-efficiency allows them to post these really outlier metrics. They don't need big margins on each sale because they turn the dollar over so many times throughout the year.
Okay, let's put Cencora in context now. Compare it directly against the other two members of that big three oligopoly. How does Cencora actually stack up against McKesson and Cardinal Health?
Well, when you line the three of them up side by side, the rational, almost commodity-like nature of this core distribution industry becomes really apparent. In terms of just pure revenue scale, Cencora's $294 billion is very close to McKesson's $309 billion. Both of them are significantly larger than Cardinal Health, which is around $227 billion.
And Cencora seems to be leading slightly on the growth front recently, clocking that 12.1% revenue growth, which just edges out McKesson's 11.6% and Cardinal Health's 10.7%. But the really telling metric, the one that underlines the core challenge, is how tightly clustered their margins are.
Exactly. The operating margin is the great differentiator in many industries, but here, it's almost the great homogenizer. Cencora's adjusted operating margin, that 1.22%, it's packed right in there with McKesson at 1.2% and Cardinal Health at 1.06%. That narrow spread, it just reinforces that they all operate under virtually identical industry pressures. They share that same low-margin, high-volume structure. They all face the same margin drag from things like GLP-1s. They all face the same immense regulatory cost burdens.
Okay, so if they're all functionally quite similar in terms of operational efficiency and that core margin structure, then the market must be valuing them differently based on something else. Yeah, maybe their perceived ability to escape that structure, their future prospects. Which brings us to Cencora's current valuation. It looks, well, elevated. Their trailing 12-month price-to-earnings ratio, the PE, is sitting around 29.6 right now. That's substantially higher than Cencora's own 10-year historical average PE, which is closer to 21.5.
Yeah, that premium valuation, that gap between the historical average and today's multiple, that is the central financial risk, or maybe opportunity, depending on your view. The market is emphatically not pricing Cencora based on the profits it's grinding out from its low-margin distribution business today. That historical PE of around 21 or 22, that reflected the stable, predictable, but low-growth profile distributor. Today's PE, closer to 30, that's pricing in a lot of optimism. It's pricing in the successful execution of the strategic pivot into higher-margin services.
A PE near 30 suggests the market is baking in near-perfect execution, doesn't it? And pretty rapid structural earnings growth going forward. I mean, what kind of long-term earnings growth rate does a multiple like that imply? And how much margin expansion do they need from acquisitions like RCA just to support that valuation, let alone drive it higher?
It implies quite a bit. It fundamentally demands that Cencora grows those new service revenues much faster than the dilution rate happening in the core distribution business. Rough numbers, if the core distribution business grows revenue 10%, but it's only earning a 1% margin on that growth, then the new service revenue needs to go, say,
20% or 30% and do it at maybe a 15% or 20% margin just to meaningfully move the needle on the company's overall profit percentage. The market, by awarding this higher multiple, has basically left Cencora very little room for error, which significantly heightens the risk profile if they stumble on the M&A integration or if the core margin pressure accelerates. ### see me as C6, risks and concluding analysis.
All right, we've laid out the strategy, the financials, the context. Now we need to really zero in on those critical headwinds, the unavoidable risks Cencora is facing.
Yes, and we absolutely have to start by reiterating the most pressing, the most fundamental risk, that structural margin compression. If the growth in lower margin products, and GLP-1s are the poster child right now, continues to outrun the successful integration and, crucially, the profitable growth of these new higher value service businesses like RCA, then the overall company profitability percentage will simply continue to decline. It's almost like running up a down escalator. This is the existential threat to the current strategy and valuation.
Okay, number one, margin compression. What's next? There's that massive risk that comes from being so essential, but also potentially incredibly dependent on just a few players. Customer concentration risk. Specifically, that relationship with Walgreens Boots Alliance, WBA.
Yeah, this is a really material risk. It often gets a bit glossed over when people focus on the sheer scale. Cencora itself describes its relationship with Walgreens as strategic and long-term. Historically, for these big distributors, dependencies like this can mean 25%, maybe even 30% or more of their total revenue is tied to a single customer. Now, obviously, Cencora benefits hugely from the stability and the massive, predictable volume that WBA provides. But the flip side is, any negative change in that single relationship could hit them disproportionately hard.
What kind of change are we talking about specifically?
Well, a few things. WBA could decide to source certain high-volume generics more directly, bypassing Cencora for some products. Or, during contract renegotiations, WBA could use its immense leverage to demand even better pricing or payment terms from Cencora, squeezing those already thin margins even further. And there's also the counterparty risk. If WBA itself were to face significant financial stress or make major strategic changes, that immediately becomes a risk for Cencora, particularly regarding the massive amount of money WBA owes them at any given time, accounts receivable. So this deep reliance means Cencora's fortunes are, to a significant degree, tethered to WBA's own strategic health and decisions. That adds a layer of volatility they don't fully control.
Makes sense. And then finally, we can't really wrap up without mentioning the persistent regulatory and legal clouds that hang over the entire oligopoly, pretty much regardless of how well they execute operationally.
No, absolutely not. They are under constant scrutiny, particularly from a political angle. First, there's always the background risk related to drug pricing. Now, distributors only account for a small slice of the final drug cost, but any sweeping legislative changes aimed at price controls, things like allowing direct government negotiation for more drugs or maybe new transparency mandates, those could potentially disrupt the current compensation models, maybe impact that working capital float advantage they have. It just introduces uncertainty. And second, there's the huge ongoing legal and compliance burden related to controlled substances. DEA oversight is incredibly strict, and understandably so. The distributors remain exposed to potential litigation, massive fines, if they're found to have failed in their duties to prevent the diversion of opioids or other controlled drugs. That requires constant, expensive compliance systems and vigilance. #B. Synthesizing the bull and bear cases.
Okay, let's try and pull all this together for the listener. We've got a pretty clear bull case and a pretty clear bear case shaping up around Cencora's future value.
Yeah, I think the bull case rests on fundamentally durability and smart strategy. Cencora holds this incredibly strong, durable oligopoly position. It's protected by really high economic moats built on scale, regulation, and complexity. They are a proven leader in distributing specialty pharmaceuticals, which is the fastest growing, highest value part of the market. The core business, despite margin pressure, is a prodigious, incredibly consistent cash flow machine. And maybe most importantly for the bulls, management isn't sitting still. They're actively, proactively executing what seems like a necessary, calculated strategic shift towards higher margin services through M&A.
Okay. Conversely, the bear case really zeroes in on execution risk and that structural margin drag. They face this persistent secular margin compression. It's driven by the sheer volume of lower margin products like the GLP-1s, which are actively diluting overall profitability percentages. There's significant M&A execution risk. Integrating these different service businesses is tough, and that risk was proven expensively by the PharmaLex write-down. They carry material customer concentration risk, heavily reliant on WBA. And all of this is happening under the shadow of an already elevated market valuation, which seems to demand sustained, near-flawless execution just to be justified.
Which brings us right back to the absolute core question, the one that's likely to drive Cencora's stock performance over the next, say, 5 to 10 years. Long-term value creation hinges completely on one thing. Can management grow these new higher-margin service businesses? RCA being the flagship example right now, can they grow them at a sufficient scale, and importantly, at a sufficient pace, to meaningfully offset the structural margin headwinds hitting that massive core distribution business? It really is a race against the dilutive gravitational pull of their own high-volume growth. They essentially have to build a new income statement profile fast enough to outrun the structural challenges of the one they already have. Hashtag tech shizzy camber.
You know, Cencora really is a fascinating, almost perfect case study in modern corporate strategy. You have this dominant, mature, highly successful company leveraging its core strength, which is that incredible, consistent cash generation, to try and fundamentally reshape its future earnings profile. It really shows how even the most indispensable businesses, the ones embedded deep in the economy, have to adapt, have to pivot when the underlying economics of their main products or services start to shift structurally against them.
Yeah, you see this dynamic playing out across lots of established industries, don't you? Dominance today doesn't automatically guarantee profitability tomorrow if the percentage of profit you earn on that dominant position starts to vanish. Cencora is essentially executing a financial migration, moving capital from the low-margin core to hopefully higher-margin adjacencies one acquisition at a time. They're trying to secure a future where services contribute much more significantly to the bottom line than just sheer distribution volume does today.
So here's our final thought for you, something to take away and maybe chew on. The market right now seems to be valuing Cencora not so much on the profit it makes distributing pills today, but much more on the expectation that it will successfully transform itself into a scaled provider of pharmaceutical services tomorrow. So here's the question. Let's say the incredible boom in things like GLP-1s keeps driving that core distribution revenue up massively. Maybe it hits $400 billion, $500 billion over the next 5 years. But what if the service revenue from RCA and similar acquisitions, while profitable, only manages to grow to, say, $10 billion or $15 billion in that same time frame? Will the sheer overwhelming scale of the low-margin core business inevitably drown out the impact of the strategic pivot, no matter how profitable those smaller service pieces are on their own? Can that small, high-margin part ever truly counteract the massive gravitational pull of the huge low-margin whole?
It's a really critical strategic juncture, not just for Cencora, but maybe for the whole industry model. And Cencora is placing a massive bet, fueled by its cash flow, on its ability to evolve.
We certainly hope this deep dive has given you a clear, focused understanding of the high-stakes strategic crossroads facing Cencora, Inc. Thanks for joining us.